Everyone for joining us today for Pristine Advisers webinar, Investing in a Low Interest Rate Environment. Upcoming and archived webinars can be found on our website, cefnetwork.com, under the Events tab. For those of you not familiar with Pristine Advisers, you can read about us on our website, pristineadvisers.com. We have a wonderful lineup of panelists for you today. Let me start off by introducing you to our moderator, Mike Patton. Mike Patton is the president of Integrity Wealth Management. He's the founder and president of Integrity Wealth Management, an RIA firm in Baton Rouge. In addition to his regular blog and new series Under the Hood for thinkadvisor.com, Mike has written a series of articles in Investment Advisor magazine detailing his road to independence from wirehouse and bank broker to fee-only independent RIA. Michael's also a regular contributor to Forbes.com. Michael, introduce our panelists for you now.
Hi, thank you, Patty. Well, we have three distinguished guests with us today, and we're excited about this, and I think everybody is interested in finding out different ways and what we can do in this zero interest rate environment. Before we introduce the panelists, let me mention a couple of house cleaning items. First, this will be available for 1 hour of CE credit for CFP designees, and Patty will give you the details on how to do that at the end. Everyone should have received the slides. If you have not received the slides, let us know and send us an email and we will get those to you. This will last about 1 hour, including Q&A. If you have your cell phone, please silence it. And then finally, if you have questions in the panel that you have, the pop-out panel, you can type your questions in there. You can direct them to whomever you like, and we will hold those questions and then answer them at the end. The reason we're going to do that rather than take them as we go is that it's very possible we will answer the question during one of the presentations. So with that, let me introduce the panelists, starting with Peter Vanderlee. Peter is a chartered financial analyst. He's also received his MBA from New York University, Leonard and Stern School of Business. He has his MS in Math Computer Science from the University of Technology in Eindhoven, Holland. He is currently the Managing Director at ClearBridge Investments. He has 16 years of investment management experience, and his current duties include co-manager responsibilities for the Tactical Dividend Income Fund, the Energy MLP Closed-End Funds, the LMP Capital and Income Fund, Equity Income Fund, and finally the Dividend Strategy Accounts. I'll go ahead and introduce Adam as well, and our third panelist, and then we'll turn it over to Peter for his portion of the program. Adam Anderson is a certified financial planner and also a certified retirement planning counselor. He's the managing director and a financial advisor at Morris Retirement Advisors, which is a private wealth advisory practice, an independent franchise of Ameriprise Financial. Adam works primarily with affluent and high net worth clients, and he's located in New Jersey. His particular areas of focus include retirement planning, charitable giving, estate planning, and education planning. He has over 10 years of experience and has received numerous awards during his tenure. He's also a member of the Career Path Committee of the Financial Planning Association. And then finally, our third panelist is Steve Bafico. He's the managing partner and CEO of Four Woods Capital Partners, based in New York City. Steve holds his BA from the University of Wisconsin and also the Series 7, 24, and 63 licenses. Formerly, Steve was a senior managing director and head of the private client group at Guggenheim Partners. While there, he held various senior positions. At BlackRock, he was also in senior positions, including the areas of sales, marketing, portfolio management, product development, investment banking, and capital markets. Steve was one of the youngest managing directors at BlackRock. Steve and his previous teams were responsible for over 50 IPOs for companies in the investment and specialty finance areas, with total assets over $50 billion. Now, with that, let me turn it over to Peter Vanderlee as our first panelist. Go ahead, Peter.
Thank you. You should see the slide, investing in a low interest rate environment. And after that, we go right into the risk reward for bonds, clearly with low interest rates that are currently here, the risk reward in bonds, in our view, appears unfavorable. The 10-year Treasury note is below 2%, and here you see the monthly yield of the KDP High Yield Index, which right now is a little bit above 5%. Those are near record low yields. As you see on the chart, that goes back to 1993. You kind of see, if you extrapolate, that the average yield is more around anywhere from like 8 to 12% in that range, and at 5.4%, you're well below the average. And indeed, it's very hard to find any kind of income in today's environment in the bond world. And with the Federal Reserve poised to rise rates later this year, the risk reward for bonds is indeed not necessarily favorable. If you take a look at the next slide, you see actually, if you're looking for income, that equities can be a very important source of that. And certainly in today's environment, if you're in search of income in this low rate environment, equities are actually the solution. If you go to the next slide, we show here the case essentially for the demand for income. The U.S. population is in such a scenario that we have a lot of folks going into retirement. There are 76 million baby boomers that are either approaching retirement or are already in retirement. And when you think about their plight in retirement from an income perspective, or more from an financial perspective, they need the equivalent of an investment trifecta. They need income, number one, to supplement the lack of savings. They need income growth, number two, to stay ahead of inflation. And they need capital preservation, number three, as risk tolerance in retirement years tends to be diminished and folks cannot afford to take too much risk. That investment trifecta is not available on the bond side. Income is not necessarily high, as we just discussed. Income growth is absent. There are coupons and they're fixed. They're not necessarily going up with inflation, for example. So you're negatively exposed to inflation on the bond side. And then with the prospect of rising rates, we're not even sure if we can look forward to capital preservation. So this trifecta, which is so much needed, is not available on the bond side. But if you go to the next page, you can see that on the equity side, particularly with respect to dividend-paying stocks, and dividends obviously are the income component of it, that trifecta may very well be available. So let's go through it. On the income side, we have a scenario right now where many dividend-paying stocks have dividend yields that are actually in excess of the corporate bond yield equivalents. So translation, stocks in many cases yield more than bonds. So from a current income perspective, you are in many cases better off with equities right now than with fixed income. Secondly, unlike fixed income, dividends are poised to rise over time, and the case for that is very strong because corporate balance sheets are flush with cash, lots of free cash flows being generated, and dividend payout ratios are actually near record lows, as you also see on this chart. So inflation protection with respect to dividend-paying stocks is going to be given to you, for example, in the form of higher dividends, and those dividend increases can very well exceed the underlying inflation rate, and that gives you the protection. And then the third component, capital preservation, granted that these are equities, so they tend to have a higher risk profile than bonds, but given where we are in the cycle, the prospects for long-term capital appreciation are still very sound. So in our view, the case for dividend-paying stocks from an income perspective remains very, very strong. If you go to the next page, you see a scenario where we look at dividends as an important component of total return on investments, and traditionally that has also been the case. And you see that here on this slide for each decade since the 1930s. And as you can tell, sometimes dividends are all you can get. Certainly if the market doesn't appreciate or declines, your dividend return is essentially more or equal to your total return. And but even in bull markets, dividends tend to provide adequate compensation for holding the equity, and can also be an important component of total return. Not surprisingly, the market has been rewarding strong dividend payers, which you can see on the next slide. And indeed, dividend-paying stocks over the cycle tend to outperform the non-dividend paying stocks or the broader market. Dividends are a sign of strength. Not every company can afford a dividend. And dividends also provide a component of total return. So even if the market is flat with dividends, you still have a return. And obviously with no dividends, you in that case don't have a return. There's many reasons why one can postulate why this phenomenon occurs, that the market seems to be rewarding strong dividend payers. And I'm just scratching the surface with what I just mentioned. So dividend-paying stocks as a source of income is an important variable for investors to look at, certainly for investors in need of income. And there are many investors that are in that bucket, not just the baby boomers. There also are the millennials, for example, who are in the process of creating wealth, of building wealth, where the lower risk profile that dividend-paying stocks typically tend to exhibit can be a helpful way for them to get started in investing. Next element of this quest for income in the equity space is the energy MLPs. Dividend-paying stocks are a compelling case, but so are energy MLPs because the U.S. is undergoing a renaissance in energy production that's quite spectacular. You see here a chart of the total production of hydrocarbons in our country, and you see that inflection point there in 2005, and ever since we have seen tremendous growth in our output of hydrocarbons. That has a reason. That's on the next slide. The reason for that precipitous appreciation in hydrocarbon output is that we have a shale revolution going on in our country, and there are many, many shales. You can see some of them on this chart. There's two highlighted, the Marcellus Shale and the Bakken Shale. The Marcellus Shale is a natural gas formation in Pennsylvania that holds around 490 trillion cubic feet of gas. So that's enough to heat homes in our country for the next 20 years. And that's just one example of a shale formation. You also see highlighted here the Bakken, which is a crude oil play in North Dakota, which holds around 3 billion barrels of recoverable oil reserves, and that's a lot there as well. And we have many, many examples of these unconventional shale formations, and the technology is now such that we can use horizontal drilling and fracking to get to those hydrocarbon deposits in a profitable manner, and that in and of itself is a growth opportunity. But better yet, what you need to facilitate this is infrastructure. You need to move, transport, and store those hydrocarbons from the wellhead where they're coming out of the ground to the end user where they're being consumed. And those infrastructure assets are typically housed in an MLP format, master limited partnership. And the attraction of that is that these MLPs tend to exhibit high current income streams, and in some cases also very attractive distribution growth profiles. The growth profile is essentially created from the volume surge that we're witnessing as a result of this unconventional drilling. And more volume, more throughput leads to higher fees for those assets that store, transport, and process them, and that leads to more revenues, which then leads to distribution growth. So the case for energy MLPs is strong. If you look at the next slide, in our estimate, we have a multi-year growth story ahead of us. This is truly something that will play itself out over a long period of time, not necessarily a few years, but could be a few decades. So you have a long runway here. We do want to caution on the next slide that not all energy MLP stocks are created equal. You can buy different kinds. You can buy exploration and production energy MLPs, where you have a lot of variability in the cash flow streams. all the way to true infrastructure energy MLPs such as pipelines, where you typically have long-term contracts with inflation escalators and fee-based business models where you have very little variability in the cash flows. You have a lot of predictability and stability there, and also inherent growth. So from a perspective of choice, there's a lot of choice in energy MLPs right now. We tend to stick with the more predictable cash flow generators as opposed to the more unpredictable and volatile ones. And as you see also here, we certainly have a wide dispersion in terms of return and growth in the space. Some are growing very fast, some are actually in decline. So there is certainly a lot of things to choose from in the energy MLP sector, and it's not homogeneous. It used to be homogeneous, but it no longer is. On the next slide, you see that energy MLPs have delivered good returns over time. This goes back to 2007, but you can go back even further, and you can see that energy MLPs have been a successful investment for those that were involved. And the last point I would make on energy MLPs is that they tend to have low correlations with other asset classes, including bonds and as well as stocks and REITs. So from a diversification standpoint, having some allocation to energy MLPs also helps, not just from an income standpoint. And then the third category of where you can find income in today's low interest rate environment is REITs, which is on the next page. And in our opinion, REITs are also an attractive investment opportunity. REITs went in the financial crisis with an over-levered balance sheet, and that led to strengthening of the balance sheet in the form of equity issuance and dividend cuts, and was kind of a bad scenario during the financial crisis for many REITs. But fast forward to today, we're in a very different situation because the economy in the U.S. is recovering quite nicely. We're also seeing both the commercial and the residential housing markets and commercial real estate markets coming out of this deep trough, and that's providing the REITs with a cyclical tailwind, and that combined with balance sheets that have been repaired sets the stage for healthy current dividends that in many cases are secure and also are poised to grow as the cash flow streams tend to increase in many of the REITs out there. So REITs are an attractive opportunity of itself. They're also a diverse asset class, as you can see on the next page. There's many different REITs that you choose from. And as we look at the yields of the REITs on the next page, we see that they're roughly in line with historical averages versus a 10-year treasury yields, so that the current income streams right now on the REIT space are anywhere from 3 to 5, 6% on the equity REITs, and much higher on the mortgage REITs. Traditionally, REITs have been good at inflation protection, which is important. You see that on the next slide. The way they give you inflation protection is, it's a real asset that you're playing. You're playing in many cases the underlying real estate, which tends to hold up much better in an inflationary environment. But with REITs, you have a liquid instrument to play that theme, and you're getting an income stream that rises faster than the underlying inflation rate. So your income growth exceeds the inflation rate, and that gives you further protection from inflation. So those are some of my thoughts. I'll wrap it up. Today's environment for income is challenged in the low interest rate environment we've been in for quite a while. Bonds are not giving you much income at all. In many cases, equity are exceeding on a current income basis what the bonds are providing. So dividend-paying stocks are a good way to look for income. But outside of dividend-paying stocks, you also have energy MLPs and REITs. And combining that into one portfolio, as we do sometimes here at ClearBridge in some of our offerings, you get a high current income stream. You retain the prospects for income growth, which gives you inflation protection, and also for capital appreciation over time, as this is equity sensitive. And these asset classes have low correlations to each other, So that aids the diversification of the overall portfolio as well. So that's a good situation to be in. So those are my thoughts. I'll leave it at this and turn it back over.
Thank you very much, Peter. Very interesting. And let me remind all of you attending today that if you have questions, type them into the message box, and we'll field those at the end. Now, without further ado, let's turn it over to Adam Anderson. Go ahead, Adam.
Good morning. We primarily work with individual clients, and many of which are the baby boomers who will need some level of current income during their retirement. So we take a highly customized approach to long-term retirement income planning. Every client situation is different, but when we're recreating a paycheck for clients, we follow a proprietary confident retirement approach that's highlighted here on this slide, and the foundation of which is impacted very heavily by the current interest rate environment. But the overall goal of the approach we follow is basically to provide that investment trifecta that Peter mentioned, but with also adding in the security of some guaranteed income. So most investors that we meet will have a plan to save for retirement, but what we find is that very few of them will have a plan to ensure that they have a predictable retirement income. And in fact, roughly half of all Americans fear that they're going to outlive their retirement income. And that's data from a survey we did that was in 2012, which officially marked the end of the 30-year bull market in bonds. So I'd expect that number to be a little bit higher if those people were repolled now. The fact is that the average 65-year-old will live on average to age 84. So it's important for us to plan retirement income that will last 25, even 30 years or more with longevity increasing. And I always think of this approach as the individuals we meet usually have a plan to get up the left side of that retirement mountain, and where we come into the picture is to help them get down the right-hand side. So if you move to the next slide there, it all starts with covering the essentials, and that's really the first step in building a confident retirement. And that's making sure that the everyday living expenses are covered with guaranteed income, like putting a roof over your head or keeping lights on, medical expenses, groceries, things of that nature. The reality is 92% of our clients believe that having essential expenses covered with guaranteed income is the #1 driver of confidence during your retirement years. So then it leaves us to solve the question of where do you get this income from? And for most people, Social Security is not the lion's share of their retirement income, but it is an important part. There are still some pensions that are out there. But if you look at the rest of the items on this list, they all have pretty unattractive yields right now, if any, and will prove to be even less attractive investments when rates eventually start to rise. So one of the things we are seeing in the low interest rate environment is that there is an increased demand for annuities that have guaranteed income riders, and we're just now starting to see some annuity providers enhancing the benefits that they provide for income purposes. On the next slide, on top of essential expenses, is ensuring lifestyle. And lifestyle is basically maximizing the ability to withdraw from investments to cover discretionary or lifestyle expenses. So we think of these as the nice to haves. So these are things like traveling and dining out, hobbies, basically enjoying life, spoiling grandkids is a common theme for our retiree clients. And most clients feel that if they have the essentials covered with guaranteed income sources, then they can afford to and should take on some level of investment risk with this portion of their investments. With low rates and faced with the eventual reality, maybe the end of this year, of rising rates, we're no longer able to invest solely in income-oriented investments for this portion of clients' portfolios. So now we really need to focus more on a total return. And the three main parts of that total return are listed here. Peter mentioned a couple of these. But it starts with having the cash and liquid alternatives. And we usually recommend to cover anywhere from 1 to 3 years of lifestyle expenses without taking on any kind of investment risk at all. And the goal here is that we want to prevent the need to sell any investments at a potentially inopportune time in the market. Without taking any risk, one of the strategies that we're using now here that we weren't a few years ago are if there's certificates or CDs involved in the mix, we're laddering them out. That way, over the next several months or year, there'll be maturities that can hopefully be rolled over to higher rates. The next piece here is the income component. And here we really had to take a step back and reevaluate the potential interest rate sensitivity in clients' portfolios, and in some cases increase the diversification by adding in floating rate loans, dividend paying stocks, a lot of quality names there on the dividend paying stocks, but also BDCs or business development companies can provide a pretty high yield. International fixed income, REITs, convertibles, as well as the master limited partnerships that were already mentioned. Right now, we also favor more individual bond ladders as opposed to bond mutual funds. Being able to fall back on holding those to maturity and having them laddered while collecting a coupon payment is a nice comfort for retirees right now, especially faced with potential principal reduction if rates rise. And the final piece here is designed to be the inflation hedge with the growth investments. And the goal there is just to maintain purchasing power and provide the opportunity for long-term growth. Our intention is that if we allow several years of appreciation on this part of the portfolio, it can eventually be sold off and then later added to the income investments, which even if rates do not rise, it will, at a minimum, increase the level of current income. And generally, this portion is not going to include any kind of bonds whatsoever, but it's more of a globally diversified portfolio of individual stocks and growth-oriented mutual funds and alternatives. So I'll turn that back over to Mike.
Thanks a lot, Adam. That was interesting. Well, let's go ahead and turn it over to Steve Baffico, and then we'll take some questions after that. Go ahead, Steve.
Mike, thanks very much, and Patty, thank you for having us on today. I think that you've been hearing from the two earlier panelists some very good observations around the challenges that the current market presents to investors, big, medium, and small, and frankly, some of the traditional ways to address those. I guess, suffice to say, and Patty, maybe we'll just flip to the next slide. We talk a lot about the new normal, and I think you've heard a lot about today some of the changes, which we think are secular changes in global markets. I might focus my comments a little bit more today on some of the structural changes to the industry. Both of these factors, I think, contribute quite substantially to the challenges that the earlier participants are referencing, and I think which all of our clients are facing. And I think the basic calculus is simply that whether you're an independent financial advisor, a manufacturer of investment products as we are at Forward Capital, or somewhere in between, maybe a consumer of both advisory services and investment products, everyone's in the liability management business. Doesn't matter if you're a large pension fund or an insurance company who's managing to a future liability, or whether you're mom and dad who are managing to a current liability. Much as Adam described in his kind of mountain accumulation to decumulation analogy. The universal challenge is really trying to make a safe, predictable 7-8% type of return. And obviously doing that in this kind of market with the structural changes to our industry and the secular challenges, or changes rather, to global markets, it's a lot harder to do this. I think that the takeaway here in our view at Forward Capital Partners is this is the template. And we're frankly, in our estimation, in the kind of early to mid stages, call it 5 years into a 15-year deleveraging cycle, whereas this is really going to be the operating climate. Greenfields in some ways with respect to systemic risk being removed, but a much more difficult landscape to navigate from a kind of an absolute return perspective. So point being, it's a forceful evolution. I'll talk a little bit about this, which really heightens dependence for investors on a couple of different things. You've heard about the need for income products today. To some degree, you've heard about the need for risk mitigation products. I think, and maybe I'll speak a little bit more to it in my comments, the use of alternative income assets or products becomes really critical, and frankly combining the three of those is the way that I think you solve this. But employing a solely traditional approach to portfolio construction is likely to elicit pretty mediocre returns. Patty, maybe we just skip to the next slide to give you some sense of the structural change in the industry. And we I think are quite familiar with this narrative coming out of the credit crisis. I think the point I would make is the upstream consolidation of the financial services industry, whether you're on the buy side, the sell side, the advisory side of the business, really changed the operating landscape in two important contexts for clients. Many of the names that you see on this list are no longer exist. And the others, which do, frankly, are kind of large monolithic institutions who, by and large, are regarded and regulated as what they call SIFIs, or systemically important financial institutions. So they're enormous bureaucracies, which are, it's very difficult to be nimble and I think to be responsive to shifting markets and, frankly, the evolving client needs that come with that. So I think in the kind of post-Great Recession era, what you have is an industry which is consolidated upstream, which in many ways has created the mega economies of scale necessary to navigate a much more complex and higher cost regulatory landscape, but in its wake has left a really below average performance in client service value proposition for customers. So, it's very difficult to be a $4 trillion firm and beat the market when you largely are the market. And it's very hard to give clients premium customer service when you're servicing tens of thousands, if not hundreds of thousands of investors. So the industry's landscape has changed structurally. We saw that several years ago in starting the firm. And I think what that would suggest simply is that there is a role and a high level of demand from investors for independent services providers or solutions providers, those which have perhaps a more bespoke approach, but have the degree of infrastructure or operating leverage that some of the larger firms have. So structural consolidation is a really important theme. Just going to the next slide, I think the other thing that has done, so you've had this forceful consolidation of industry, be it through shotgun marriages, bankruptcies, mergers, what have you. You've also had enormous intervention on behalf of central governments, central banks rather, globally. What I'm showing you here is just simply what the world looks like in fixed income, and that is a much more homogeneous type of market. And this is largely kind of a result in the U.S. fixed income markets of the mortgage institutions being put into conservancy, and obviously the massive issuance of treasuries. My point in illustrating this is that these are kind of structural changes to industry, but more secular changes to markets. I mean, the only exit from the right-hand side of the screen, what the Barclays Ag looks like today, where you can see, the vast majority of the U.S. fixed income market, 80% are government-related assets, is natural runoff and expiration. And that goes out another 5 years and beyond. So while you've taken a lot of systemic risk out of the system and limited levels of leverage overall, and regulated firms out of businesses, proprietary businesses, and risk-taking businesses that they were once in its place, you've got a very vanilla, low-rate environment and very difficult to navigate. I think what that would suggest is, the Fed is chasing its tail here, folks. whether it's a strong dollar, decline in commodities, real structural unemployment issues that we have in this country, the reverse effect of quantitative easing, all of these things make it very difficult, as well as kind of the obvious facts, which is that you have a very one-dimensional U.S. fixed income market, almost impossible for rates to go up. So I think the Fed is trying to talk the market into a rate increase at the end of this year. We don't think it's going to happen. In fact, it may be well into next year or beyond that you even can make a strong and credible case to raise rates. You're going to see the economy choke down in the next half of the year, particularly the energy sector and the E&P side of the market, and that's going to also, I think, make the case that the brakes are on here modestly, and rates just aren't going up. So the point is, it's a tough market to call, and if we flip to the next slide, I think what that means is it's a very tough market to invest in. Why? Because all markets become correlated where there's no kind of directional leadership. And, whether that's you're a debt investor, and as I said, the quantitative easing has been positive for some markets, but very difficult for fixed income investors because it's had some reflationary outcomes, but in many ways it's had the reverse effect. You see the 10-year trading at sub 2% or around 2% for the last 3 years. I don't think anybody expected to see that. So this flight to quality and kind of deflationary type of environment, you could be argued, is having the reverse impact. So equities has been a very tough place to be, risk on, risk off. I think professional investors have had an incredibly difficult time toggling between debt, equity, and volatility markets. And I think, in fact, professional investors have gotten it so wrong, that you see kind of investment vehicles, specifically the hedge fund industry, which are set up essentially to be low correlated drivers of alpha or excess return, frankly underperforming massively. And it's why big institutions, pension plan and institutional investors like CalPERS have thrown up their hands. They said enough. No more premium fees for sub kind of beta returns and high correlation of performance and risk. So it's been a very difficult market to invest in, I think, as you're hearing today. So I guess the question is, and what we're really doing this webinar about, is what do you do with your money, and how do you make returns? How do you create compelling cash flow on the next slide, and principal protection elements to your portfolio? Well, as we talked about, we're all in the liability management business. Doesn't matter what side of the trade you're on. The buy or the sell side of that. I guess you've heard a lot kind of around the middle bracket, the traditional asset solution base today on the call. And again, if you're of the belief that we are 5 years into a 15-year deleveraging super cycle, not only in this country but globally, and I think you see the same impact in Europe even more acutely with the rules and regs to some degree. Think about capital structure, okay? So if everybody's managing to an 8% return bogey, just in the traditional asset bucket, equities yield 3%. Corporate bonds, investment-grade corporate bonds yield 3.5%. High-yield bonds you saw on Peter's chart earlier yield 5%. Senior loans yield 4%. Preferred stock yields 6%. Folks, cash is zero. No combination of 3, 4, 5, and 6 is going to get you to 8. It just won't. So the reality is, the way we think about constructing cash flow and principal protection portfolios is diversified yield investing across multiple verticals. The need, or critical need, from a liability management perspective, to include alternative assets and real assets in a portfolio to greater degree than you've ever had is mission critical today, and we think, given some of these structural changes to the markets, is going to be relevant over the next decade and beyond. So what do you do? Let's talk a little bit about alternatives. It's a catchy, kind of a catch-all phrase as to what actually constitutes an alternative asset. At my firm, we are focused on one thing and one thing only: manufacturing, cash flow based, yield oriented returns that have adequate principal protection elements to the strategies and to the portfolios that we build. So cash flow and principal protection are king. So when I think about alternative assets, it's what type of assets give me above market yield with below market risk, or where are the best risk adjusted returns? And frankly, these are going to be in non-traditional areas of the market. Alternative credit is going to be, I think, the story that carries the day over the next 10 years. If you think about what the regulatory framework has created, it's an operating climate or template which has pushed out traditional purveyors of credit, i.e. commercial banks, from many, many areas of the market which they once serviced. These include, kind of capital-intensive cyclical businesses like energy, like aircraft, like shipping, and other transport, industrials. The mainstream commercial banking sector largely does a very poor job of providing credit in these type of areas of the market. So the emergence of specialty lending companies or direct lending platforms, what I'll call alternative credit managers, places where you're going to get the best risk-adjusted returns. Senior secured in the capital structure, well above average of any of the traditional assets that I've described, but which require a high degree of specialty discipline. So I think you're going to see the emergence, and we're doing that at our firm, of lending platforms or vehicles which focus on industry verticals who have been disintermediated from the financial services or the banking industry as a result of everything that's happened. So aircraft, shipping, industrials, energy certainly to a degree. If you have the ability, and I think Adam referenced business development companies, we think that is, the non-bank bank sector is the engine of growth over the next 5 to 10 years in this country. It is where the majority of credit is being generated and extended into the market. And those type of middle market companies which are recipients of that credit are effectively where 95% of the net new jobs are created in this country. So in order for us to grow above 2.5%, in GDP, you need those small and medium-sized businesses to get credit, to expand the businesses, and to create jobs. And to ensure that happens, you're also going to need to have a very low-rate environment so that those companies can service their debt. So again, it all kind of goes back to the Fed's conundrum in its inability to raise rates of any substantial degree over a very long period of time. So how do you invest in alternatives? It's through direct lending vehicles or specialty finance companies, which will be taking the place or are taking the place of traditional banks in the space. You're also seeing a tremendous consolidation of community and regional banks, which will kind of continue to trade off of the more difficult operating climate. Lastly, on the left-hand side of the page, just kind of talking about real assets, energy we think is a tremendous area of opportunity. You heard Peter talk about essentially the midstream transport way to access the energy sector, and that's really what the Master Limited Partnership or the MLP sector speaks to, and that is the transportation of hydrocarbons once they've been produced from the ground and before they've been refined and get to market. So transport industry we do think will be a continued source of opportunity, but more so we think that you're going to see the exploration and production or the upstream sector of the market really fall on its face in the second part of the year. Commodity prices will stay low. I don't think people really understand the impact of that long term. Yes, production levels are actually stable to higher than they were, but they're running at full clip because most of these E&P operators are undercapitalized and have to pump product out of the ground to pay the massive level of debt and leverage in the business that's been created over the last couple of years. So what's the opportunity for investors? Again, specialized asset management around these type of special situations. You will see more kind of merchant banking vehicles or opportunistic energy funds which focus on a couple areas of the market. Acting as a senior secured direct lender to energy markets, acting as a purchaser of VPP or variable production programs, all of these yield-based strategies which allow investors to clip a coupon from a high part or high position in the capital structure, and doing so therein, generate better risk-adjusted returns. The difference is it's specialized asset management and really niche. That's harder to industrialize. This is certainly, these are certainly disciplines which, in our opinion, are much, much more difficult for an individual practitioner or an individual investor to replicate. So, kind of high value add, high alpha areas that provide low correlated, the best risk-adjusted returns and a significant alpha relative to some of the traditional assets. So just a couple thoughts from Forward Capital's perspective on how to be yield focused, how to be outcome oriented, and to augment a traditional portfolio through the use of alternative credit and real assets as a measure of diversification and excess yield. Mike, I'll turn it back to you from there.
Thank you, Steve. Steve, let me ask you a question. We have a few questions that came in, but let me follow up. It sounds like what you're saying is you're having to dig deeper into, say, the debt market or the fixed income market to find, specific slices of that market in which to invest. That's kind of what you're saying? I mean, it's no longer just yesterday's interest rates are high, so you can pretty well make money in any of the broader debt markets. You're having to go in deeper and more granularly. Is that what you're saying?
Mike, that's exactly right, and I think the examples around the specialized disciplines I think epitomize the challenge that kind of on-the-run professional investors and frankly income-oriented investors are having in this kind of market.
Good, good. Well, look, thanks. Listen, we have a few questions that have come in. Let me remind those of you attending to, if you have questions, go ahead. Now is the time to type them in, and we'll take 10 or 15 minutes, whatever is necessary, up to about an hour or so, and we'll answer those. We have about 10 minutes left, so let's start. We have one, and I'll throw this out to any of the panelists that would like to respond, but it's about master limited partnerships. Two things that seem to be popping up here. One is the liquidity of the, and specifically energy MLPs, as Peter mentioned, the liquidity of those as well as their relationship to the sensitivity to oil prices rising or falling. Could somebody address that, please?
It's Peter. I can start. Liquidity is improving in the space. The entire space, energy MLPs, is now in excess of $700 billion, and it's growing. There are some names where liquidity is still a little bit challenging, specifically for the newer ones that have come to market. But we're also seeing multi-cap, large-cap names, I should say, in the space, like an Energy Transfer Partners, Energy Transfer Equity, just an Enterprise. I mean, these are, large-cap names. So liquidity is improving, and on the whole is adequate. With respect to the relationship with oil prices, it depends where you are in the spectrum for energy MLPs. If you're on the exploration and production side, you certainly have a lot of correlation with the price of crude oil in terms of your cash flows. But there are ways in energy MLPs to insulate yourself from the price of crude oil. You can be 2 steps removed from it with energy infrastructure assets such as pipelines. The first step is that many of those energy infrastructure assets depend on volume and throughput, and not on the price of crude oil or natural gas for that matter. In other words, they're toll roads. Doesn't matter what the price of the car is that goes over the toll road, it's the same toll. It could be a Volkswagen or Ferrari, it doesn't matter. And these infrastructure assets that I'm describing are a little bit like that, and that is the first step, that you are removed from the price of crude oil. The second step is by having assurances in the contracts themselves. Some of these contracts have, for example, minimum volume commitments and take-or-pay provisions, which essentially insulate the infrastructure asset owner, the energy MLP in this case, from even the price of the commodity being very low for a long period of time. So there are ways to remove yourself from it, and there are ways to be very exposed to it. It all depends where you are in the spectrum for energy MLPs.
So choose it carefully, I guess. Thank you, Peter. Another question came in, and I'm reading the question. I'll put it in my own words. But Bill Bengen is the sort of the father of the safe max withdrawal percentage. You could draw out 3.7% or 4% of your portfolio and be fairly assured of not running out of money. Obviously, with interest rates lower, that may have changed. So would anybody like to touch on this? And how has the low interest rate environment impacted these withdrawal rates?
Yeah, this is Adam. I can take that one. And you know that's exactly right. I mean, for many years, the general rule of thumb has been that a properly diversified portfolio should last 30 years or more if your initial withdrawal rate is 4% or less, and then that gets adjusted annually for inflation. But the last 30 years has been a bull market for bonds with, I think, an average return on investment grade around 9% over that period. And we've already discussed that that's not true today and is unlikely to continue. So there's been quite a bit of controversy about that recently, and there's even some research that indicates an appropriate withdrawal rate now in this new low interest rate environment is only 2.8%. But with that being said, I mean, it doesn't change the need for yield that investors and specifically retirees need to recreate a paycheck. So for us, I mean, it's just been a lot more focus on total return, and it's increased the importance of guaranteed income sources to cover the essential living expenses I mentioned before. In some cases, also changed the recommendations that will make as far as when and how to file for Social Security or pensions, and recommending the features on annuities. There's some annuity products that exist today that can guarantee a withdrawal rate of as high as 7% for older individuals. So I think to summarize that, I mean, instead of just that general rule of thumb of 4%, we need to be a lot more adaptive about our withdrawal strategy. And, you know, 4% might make sense now, but in 2 years from now, it might need to be reduced to 3 or 3.5 when conditions change in the market. But, you know, at the same time, 5 years from now, we might be able to go up to 6%. So it's something that needs to be much more closely monitored than it used to be.
Great. I guess you just need to be a little more agile. And again, like Steve was talking about, you have to get a little bit more granular, look a little closer, and you know the general rules of thumb may not apply in every situation. Good point, Adam. Here's a question. Let me read this. I guess this is directed to you, Steve. It says, you see, talk about the evolution, opportunities, and risks of alternative credit as you have outlined them in your presentation.
Sure. You know, I mean, I've spoken to a couple of areas of development or evolution. I guess it's kind of more of an evolution versus revolution conversation, Mike, in that sense. But you know, as you've heard, the hard and soft catalysts, which I think force investors and advisors to look at a greater usage of non-traditional yield-oriented instruments. Those are catalysts which are here to stay. We've talked a little bit about kind of this emergence of specialty lending vehicles, so senior debt primarily that will be more focused on a particular industry vertical. Now, the specialty lending concept in itself is not necessarily a new concept. I think business development companies have been, quite proficient lenders as generalists in this space over the last decade, as that genre has grown quite a bit. Normally a business development company will invest or lend to a broad, diversified portfolio of middle market type of companies, which may compose some or all of, the type of companies I referenced earlier. So manufacturing companies, steel companies, widget makers, things that in this kind of day and era from a regulatory and risk construct. The financial institutions are today, not by necessarily their own doing, but they are largely out of the market of effectively pricing risk. And prior to the credit crisis, we had a pretty effective system of the market kind of regulating and pricing and risk. And, the way that capital ratios are now structured, largely kind of dovetailing off of FinReg and things like Basel III, it makes what are considered or construed as higher risk or heavier cap ratio weighted sectors much less attractive to lend to. And so, things that are more capital intensive or asset based in nature, as I mentioned, shipping or aircraft or industrials, those are generally areas other than the kind of top end of the market at the larger kind of spectrum that financial institutions really are disincented to lend to. So where BDCs as generalist lenders have traditionally done a pretty good job in servicing those areas of the market, I believe what you are seeing is now an emergence of specialty vertical or industry-focused lenders, which are largely taking the place of the regional and community banks that have traditionally served those industries geographically. So you're seeing those roll up into kind of national specialty lending companies that just focus on, middle shipping, middle market aircraft leasing, industrials, energy. So, those are four areas where we think you're going to see a much higher degree of specialization from a yield perspective, because these are generally debt vehicles or companies. But as we've heard, there's a lot of price dislocation across the capital structure in it. So, in energy, I think is the best example of that, where there's a tremendous need for capital. Of capital pull back, and so there's going to be kind of a supply-demand imbalance where specialty providers will step in. Having said that, there's also kind of traditional corporate debt and high-yield bonds and loans, which, as here can attest, are trading. There's a lot of price dislocation in the established on-the-run, parts of a company's capital structure. So being able to have vehicles which capture both the kind of need for direct lending of capital as well as the kind of price dislocation in traditional securities, I think are going to be a great place for investors to make yield-oriented returns. Two other areas of the market I'll mention very briefly, and I think it's something to keep your eye on. There is a tremendous growth in very, very innovative debt securities or lending techniques. You're going to hear a lot more about the peer-to-peer lending sector and those which securitize the peer-to-peer lending operations and create very attractive 8, 9, 10% type of returns, cash flow-based returns for investors. As well, we didn't really touch on munis today, but there's a growing and fertile segment of the municipal market in smaller deals, kind of high-yield, non-rated deals by design, which are first lien, senior secured with great outsized returns, 6, 7, 8% tax-free type of return. So in any and all,
like we almost need to have a whole other webinar on this.
It's an exciting time to be an alternative yield. Yeah.
Listen, we need to wrap this up. We have time for one more question, and I think the attendees will agree. This is a question. It's the mother of all questions. This is the question that everybody wants to know. At some point, the Fed will, and I'd like to open it up to all three of the panelists, to those who would like to answer, but to keep your answers, let's say a minute or so, and let's just briefly touch on this. Give me your best idea here. When interest rates begin to rise, whenever that is, whether it's June, September, or next year, when that occurs, want to be in the fixed income world. And again, brief answers. Conclude with this, but where do you want to be? Where don't you want to be? What do you want to avoid? But go ahead, any of you, jump right in.
It's Peter here. There's a mathematical formula for bonds, right? Rates go up, bonds go down.
Right.
So that's the math of it. And, I suppose you want to look elsewhere if you believe a rising rate environment is upon you. You don't necessarily want to be overly concentrated in fixed income. That's just the math of it. I think we have a pretty good case for equities as an alternative. Equities tend to react much better in a rising rate environment than fixed income, and there's a lot of reasons for that. And I think specifically within the equity realm, you want to look for those companies that have the ability to grow, because growth is the antidote for a rising rate environment. And the growth can come from dividend growth, distribution growth, or also top-line growth, but I think that's where you want to focus your attention on.
Very good. Adam or Steve, would you like to briefly touch on that?
Yeah, I would just comment that, above all else, it remains critical to stay diversified. And if it is in fixed income or bonds specifically, short-term should hold up better. And, we're taking a more active position in more dividend-paying stocks and dividend-growing stocks.
Great, great. Adam, any thoughts? Maybe what to avoid? Where would you go, or where would you stay away from?
Mike, this is Steve. Maybe I'll just conclude. I mean, I think that to Adam's point with respect to kind of growth and income-oriented equities, right? So companies which have above-average dividends but have well above-average growth rates from an earnings perspective should be an excellent place to be in a rising rate environment. And then, of course, the obvious in fixed income, those type of fixed income securities with a variable rate coupon, so a floating rate coupon, which normally have high position in the capital structure and collateral underpinning them. From a protectionary standpoint, I think those are the two places where you'd like to be. Obviously, where do you not want to be? You probably don't want to be long, spread assets like, government spread assets and treasuries and that kind of stuff, which have, to Peter's point, longer durations and significantly greater price risk.
Great, very good. Well, listen, Peter Vanderlee, Adam Anderson, Stephen Baffico, we'd like to thank you for being with us. I'm going to turn it over to Patty for a few concluding remarks, and I'd like to thank all of you who attended, and hope you enjoyed the webinar. Patty, go ahead.
Well, I just want to thank everybody again, thank our panelists and our moderator for giving us the time and this very interesting and educational webinar. There will be a replay of the event. You could email us at events@pristineadvisers.com for the replay link. We will also be posting this around on social media as well. And again, anybody interested in the CFP credits, again, just email us at events@pristineadvisers.com and we'll take care of that for you. So gentlemen, thank you so much again. We really appreciate it. If anybody has ideas for upcoming webinars, feel free to let us know. And don't forget to check out our cefnetwork.com events for upcoming webinars. Thank you.
Thank you.